Welcome, welcome, welcome. Welcome to Crashes and Taxes. I am your host for the podcast, Rebecca Walser. And for those of you just joining who don't know who I am or what I'm about, you'll find out really fast. But I am a certified financial planner. I am a tax attorney, and I have my own wealth management practice, a national practice based in Tampa. It's called Walser Wealth Management. If you want to know more about the practice, you can always go to walserwealth.com. And you can always give us a call at the office, 866-929-3258, 866-92-WEALTH, 866-92-WEALTH. But I am here today to talk to my Crashes and Taxes audience about what the heck is going on in this market. Worst 4 weeks we've seen in a substantial amount of time, worst January, I think since 2008. And the Federal Reserve this week basically came out and said that we would start rate hiking in March. I expect 25 basis points at least in March. And, I'm thinking 3 rate hikes this year is what I think is a reasonable rate hiking position from the Fed, because you have to remember, at the same time the Federal Reserve is rate hiking, they're also they will begin to run off their balance sheet. So let me explain what I mean by it. What does runoff mean? What does federal runoff mean? So stimulus is when we go out, quantitative easing is really the technical term. The Federal Reserve goes out and buys treasury securities from the actual market, and they buy from the U.S. government, their treasury. They're buying securities from the treasury, and they're also buying mortgage-backed securities on the open market. And so they had, through Corona, done that to the tune, as you guys know, I've told you many times if you listen to this show, they did that to the tune of $120 billion a month. That's $1.3 trillion a year that we stimulated monthly through the period of the 20 months at least of Corona. And then they're pulling back on some of their stimulus, but we are still stimulating. That has got to get to a zero level by March so they can start raising rates. They don't want to be buying these things while they're actually, raising rates, costing themselves more money to buy them. So obviously they want to stop the stimulus before they start the rate hike. And that's what they're trying to do, is really get that down to a zero almost level by March, because then they're going to start something we call runoff. Runoff is when, instead of buying things and putting money into the market, and that gives us that extra cash that's available in the market to go into equities. Instead of doing that, they start selling. They start running off their $9 trillion balance sheet. They start running off securities, meaning they go into the market and become a seller. And that means they're sucking money supply from the market. They are sucking it up. And that takes away money supply from the market, making the money supply contract. And when the money supply is contracting, then we can have we can get some inflationary impacts on that. So that's what they're doing. They overinflated through Corona. We had too much cash. Think about this. Just think about just a basic economic example. It's economics 101. If I have a finite amount of goods and services, which we in America have. We cannot just invent more services and have more goods. We have a finite amount of goods and services. You can see that now more than ever with the supply chain problems between China and energy prices. You can see that we're having, and also the vaccine mandates that are the cross-border transactions are problematic. That's why there's this big, some kind of world record-setting convoy between Canada and the U.S. I think it's like 43 miles long of just truckers lining the convoy. These are all the truckers that are not able now to enter our transfer borders between Trudeau and Biden's policy of no vaccine crossing. Truckers, non-vaccinated truckers cannot cross. So we've got supply chain issues. But if you think about going back to finite amount of goods and services, if the money supply on the earth in America is $100 million, and that is all we have to spend for amount of finite goods and services, and the Federal Reserve stimulates and puts out additional $50 million, this is obviously a low example, then we have $150 million, but we now have $50 million more dollars, but we still have the same finite amount of goods and services. So what ends up happening is people start bidding up the price for what they want because it's finite, it's limited, and prices start to go up. When you increase the money supply available, you're increasing demand, but you're not increasing supply. In fact, in this case, in this real world example, we're contracting supply because we have supply chain issues, not only here in the US between our largest trading partners, which are Canada and Mexico, but we also have supply chain problems with China that we've had literally since, a long time, but it was all the way through 2021. And there was many points of last year where we had at least 100 freight carriers off the coast of California that weren't even they didn't even have the dock staff able to work to, unload these trucks. So we have a supply side that's contracting while we have a demand side that's, has more cash flow to bid up the price. And so you're going to get inflationary pressure. Inflation just means I can buy an apple today for $1 and tomorrow it's $1.50. That's inflation. It's the same apple. It costs me more money. And as we have an inflated money supply, too much cash in the market, prices inflate. And this is why you can look at the S&P 500 and you can look at the recovery line from the low of Corona to the high through the end of last year, 2021. And you can see literally one of, or if not, I think it is the tightest slope. In other words, it is almost a straight line up of a recovery. It's just a little bit off to the right, but I have never seen such a straight line up from a recovery. And that means we overstimulated, and that means we got inflationary pressure. Once we went +% off of our high before Corona, it was really inflationary. We didn't have the economic fundamentals because we had a lot of problems with the global pandemic, shutting down employment, shutting down businesses, shutting down concerts and sports revenues and restaurants and bars. And we are a 70% servicing based economy. So if we shut down the things that people buy services at, restaurants, bars, theaters, movie theaters, Broadway, concerts, games, all the sports games that, remember, we didn't even have people out. They had those fake people in the stands in 2020 at the end. So we have a contraction of supply, we have an oversupplied cash flow, and that's why inflation has gone up. So in order for inflation to now go back down for the Fed to control inflation to the level that they want to control it at, they are going to suck money out of the economy, and they do that by selling off their balance sheet and having people in the economy buy their balance sheet that they are going to be running it off. And then that way there'll be less money supply. They're going to contract the money supply, and therefore they're going to attempt to try to curb inflation. As far as the news that's come out this week as to what should actually, where the rate hikes look, you have Bank of America that came out on Friday, January 28th, saying that they expect 7 rate hikes this year. Through this process. And I got to tell you, considering that the Fed this week suggested, at least at the FOMC meeting of January, they suggested that we wouldn't see rate hikes until March. I think it's going to really be difficult for us to even logistically accommodate 7 rate hikes. But not only logistically accommodate 7 rate hikes, I think it would be absolutely endemic and a disaster for the market. I mean, you cannot go from having a quantitative easing policy since 2009. It's very accommodative, very putting a lot of money in, just having the too big to fail. We can't let the market crash. We're just going to push the money in. You had a lot of people pushing MMT, modern monetary theory. That theory is basically, in a nutshell, this is not the official legal educational definition, but modern monetary theory, MMT, in a nutshell, basically says that it's kind of a Keynesian economic model. And it basically says that we can spend as much as we want and there will be no impact. We can print as much money. The Federal Reserve can print as much money, and that is not a government institution, but they can print as much money as they want, and there will not be any problem with that as long as we can service the debt. In other words, inflation's not a problem. Those things don't happen because as long as you're servicing your debt, you won't have that problem. And you can see that is apparently it's just not the case. Now, you could say, as from an economic perspective, if I was arguing against myself, I would say, well, how do we know it's not the supply chain that's causing, the inflation? And the reason that we know it's not the supply chain is because we had supply chain issues as soon as Corona hit, and we didn't have inflation until 2021. It wasn't until all of this stimulus had really been put into the market that basically we know it's not the supply chain alone. Supply chain is a contributing factor, but certainly it is not the supply chain alone. So what do you do in a market like this? And this, let's be clear, these are some of the most serious headwinds we have ever had in the history of time. And I am not a pessimist. I am not a negative Nelly that wants to just sit here and just bam, 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 my podcast Crashes and Taxes with negativity, because I'm actually always glasses half full person, always wanting to see the silver lining, always wanting to see how can we go out there and do what's best for our clients and our investors. And that's why I do this talk with you, just generally to the public. And I don't give you all the information. I give them obviously my clients, but general information to the public, I'm letting you know what's going on. And I have just never seen this confluence of factors, economically, geopolitically, just in my life. And nor has it been this way ever, and probably at least over 200 years. And so what am I talking about? I'm talking about the collapse potentially of China's economy, because we know that their property economy is collapsing. And of course, China is going to do everything they can to stimulate and to not let their economy fail. But it's the second that their coronavirus protocols get triggered, they shut down full ports. I mean, we're talking some of the largest ports in the world. They will shut them down. And this is why they've shut down manufacturing plants, which the United States relies on heavily. China is our manufacturer. I mean, they are the manufacturer of the United States. Period. End of story. That's it. So if they're shutting down their manufacturing plants over there, we're going to feel the reverberations of that over here. Okay, we are doing all of these things at a time where we have IoT, the Internet of Things, where everything in the future, the plan will be connected to the internet. In order to be connected to the internet, you have to have a chip. Well, guess what? We don't have these chips. We have major chip shortages. These chip shortages need to be fulfilled. And I think it was probably a pretty big oversight from the industry to not recognize that IoT was going to change everything. Your toaster, your blender, your refrigerator, everything is connected to the internet. And all of that requires chips and processing power. And we don't have that. So we have news that, a new chip plant is going to be made potentially in Ohio, but this is a long-term investment. It's certainly not going to affect anything here. So we've got major chip shortages. We have auto dealerships that cannot get new cars. They could potentially go out of business. Used cars are surging because they're here. Again, the demand is pushing prices up. New cars aren't coming. So now we're going to be buying the used cars. They're so much more valuable. And you can see the prices just gone up, that the prices for all, real estate across the country has gone up astronomically for the locations that are attractive. Now, from the urban cities, certainly the cities that are experiencing crime waves, which is a whole nother disaster that we're seeing right now. We've got a lot of different policies. And let's take New York City, which I consider to be a second home. I went to NYU, but if you look at New York City, they have they've gone to somewhat of a cashless bail system for specific types of crimes. And we've seen even, people that are accused of murder are out on bail within a matter of, less than a week. But let's go to San Francisco. You've got San Francisco where they've decriminalized. In other words, they've basically said we will not prosecute shoplifters if they shoplift under a certain dollar limit. So now you've seen across this country on the news all of these flash mobs crashing in Chicago and San Francisco, going in and smashing a store's windows and grabbing as much as they can. So now we've got a crime wave. I think a lot of that might have been a part of that defund the police movement that came in 2020. And 2020 was election year, obviously. A lot of DAs were elected in that year. There was a big defund the police movement. So a lot of district attorneys filled these offices of these cities across the country that we're talking about, and they've implemented these cash bail policies, or they've also implemented policies that just don't pursue crime. So, a district attorney has to actually say, yes, we're going to prosecute you. We're going to have it needs to be formally indicted. We're going to indict you. We're going to prosecute you. Well, district attorney has discretion, because a lot of times there are circumstances we want a district attorney to have discretion. We don't want it to be a smart contract where we say, did you violate this law? Yes or no? You did. You were found to. You're on video here. You're doing it. So we're going to go ahead and prosecute you for this crime at this time. End of story. There's no discretion. We want to have human discretion because there are circumstances that could, let me just give you a perfect example. And this is kind of reminding me of law school, but I give you a perfect example. We just said that we saw somebody on video robbing somebody. So we know that we need to convict him of that crime, right? Well, you find out later that, somebody was outside holding their 2-year-old at a knife point, telling them go inside and rob the store for me. So now, did that person commit a crime, or was there extenuating circumstances? And so therefore, the law cannot be as black and white as everyone thinks it can be. And that's why there's gray areas that require human discretion. So these DAs basically got elected, or they have already been elected, and they're not prosecuting crime. So we have this crime wave. We have the border the laws aren't being enforced. So we have a lot of, we've had over 2 million people came into this country last year illegally. Fox News reported this week and they had the video of, young adolescent males, not with families, not with women, not with children, being brought in to states in the middle of the night and then being taken by cab to the airport to be flown anywhere throughout our country. Apparently, the Biden administration has stated that 60% of the people that came in last year, they did not move back to Mexico through the Remain in Mexico policy, which just was reinstated by the Supreme Court last year and the last half of last year. So we have a lot going on. On top of that, we have Russia and the Ukraine issue, and we have China and Taiwan. So we could have a world event as far as some kind of military action for the US to get involved in, which the American people seem to be absolutely against. It was funny, I saw a meme. It was about, basically Russia invading Ukraine and the non-appetite that America has to get into another regional conflict that's not really a part of anything that we have to do with, because the meme basically said, we're going to go to Ukraine to defend Ukraine against Russia to enforce Ukraine's border, but we don't defend our own border. And I don't think Americans have an appetite for another Afghanistan at all. And not only that, but Russia is in Afghanistan, right? You got to decide. It's a really tough decision if you want to decide to go to war with Putin. I mean, we're talking about another world superpower. This is not Afghanistan. So we have that going on. All of that said, I am seeing in my future and in your future and in America's future a substantial market event. And I've been saying this to you guys for a while. I'm trying to prepare the Crashes and Taxes audience for the fact that we are going to see substantial market events. And I would say, and I can't mark a time, I'm not God, I don't know when, but I would say, you should really buckle up for the next 90 days and be prepared. Be prepared to see major things coming that you're not going to maybe even understand or won't be explainable. I will definitely do my best all along to inform and to guide and to give you, just general advice. I can't give direct, specific advice, financial or legal, on a public podcast, but I just want everyone to be prepared. If you're a long-term investor who is already retired, living off of distributions, and you can't afford to go through a market correction, you need to move to safety. You need to move to safety. The VIX, the volatility, it is not going to stop. This is the volatility we have while we know that rates aren't even going to start rising until March. What happens in March when they start rising? What happens if we get 7 rate hikes? 7 rate hikes and the market is decimated. You cannot go from flooding the market and stimulating the market for 12 years to just literally sucking all of the liquidity dry and raising rates to normalization 5-6% late. You just can't, it's just not going to work. It's not going to work. The Federal Reserve is in a corner. They have to control inflation and employment, but they can't do it in such a way that literally decimates our economy in the process. So I would just tell long-term investors, go to safety. Short-term investors that know what they're doing, that are sophisticated, there's places to make money. You can certainly do some option strategy on both sides. I would make sure you're covered. But certainly there's short-term opportunities, but you also have to be really non-risk adverse, because these are certainly a lot more speculative plays than what we would normally be seeing. And so you've got to have the ability to make sure if you do, if you do some options, you have the ability financially to cover those things. I'm not giving you options advice. There's all kinds of courses out there on how you can cover yourself on both sides of a transaction and make money. And that's really sophisticated. And so I'm not encouraging would you need to go out and do that? Unless it's a passion of yours, because it is quite sophisticated, usually takes professionals. But again, there are short-term things that could be done. But even that, I still have to warn you, strongly warn you that with things that are coming, we need to be vigilant and alert. And the last thing I will just share with you is I am expecting to hear in the next 2 weeks throughout the media a new virus coming to America called Marburg, M-A-R-B-U-G, Marburg. It is a hemorrhagic fever virus that basically causes fever, nausea, vomiting, diarrhea, and its incubation period is 21 days. It has, unfortunately, a fatality rate from 24 to 88%, with the average being 50. But the good news is that it is not passed through the air. It does have to be passed through bodily fluids. So it looks like it would be a lot less contagious. I have been informed for a while that this was going to be coming. I wasn't sure how it was going to get here. And I'm not even sure still if this is what it is, because it hasn't been reported yet. But like I said, watch the media for the next 14 days. A CDC truck in Pennsylvania the last week of January, in fact, Monday the 24th, basically was traveling with some monkeys, and the truck hit a dump truck and the monkeys escaped in Pennsylvania. They were able to recapture the monkeys. They did euthanize the monkeys. That was on Monday. The next day, on Tuesday, we heard that a woman who encountered the monkeys was starting to feel sick. On Wednesday, just get the date here, the 26th, on Wednesday the 26th, the CDC sent an email or a letter rather, to the first responders and said, if you are experiencing fever, diarrhea, vomiting, nausea, you need to quarantine for 31 days. As I told you, the incubation period for Marburg is 21 days. So they said you need to quarantine for 31 days. And so right then, when I read the letter and I read the description of the symptoms, I knew immediately that this is and does sound like Marburg. We didn't at the time know where the monkeys came from. I said, if the monkeys, because Marburg is a human and primate virus, I said, if the monkeys came from Africa, if I find out they came from Africa, then this is definitely Marburg. And it came out on Thursday, I believe, or maybe even later that Wednesday, the 26th and the 27th, that in fact the monkeys are from Africa. So now we know that I think this is how Marburg is actually coming to the United States, and that is a concern. But I don't want you to be afraid, because I think that we can't handle the fear with the market we already have. We cannot be afraid in this country. We have to realize that, our life is precious and valuable, and we can't live it in a box without any risk, because that's not a life worth living. So don't be afraid. It's not corona, it's not airborne, and we just have to get through whatever will come. But it is going to be a rough go. So from an investment perspective, everyone, expect the worst. Take as much safety as your risk tolerance will allow you to take. Take as little risk as you have to within your risk tolerance. And then after these next 90 days, I think you'll be much happier that you took those actions. And I think that you will also be much happier that you listened to Crashes and Taxes with right here, your host, Rebecca Walser. Until next week, everybody, thank you for joining and listening. If you like the podcast, tell your friends, and obviously give us 5 stars. We really appreciate that. Next time, guys, we'll see you soon.